I've mentioned before, and I'll reiterate it, if it isn't going to collapse entirely, it's heading for massive growth. It's an all-or-nothing scenario. If it were worthless, it would have been eliminated or prohibited by now. Clearly, we can see that it's not being banned. There's no chance that major institutions like Fidelity, Citadel, BlackRock, Charles Schwab, Deutsche Bank, Crédit Agricole, Banco Santander, and others would show interest in something they didn't deem valuable. These organizations aren't backing a fleeting trend. Once the value shifts from zero to something substantial, the perspective changes. The question becomes, if this is now a recognized asset class, what is its potential value? If it captures even 1% of the world's assets, its value could increase by 10 to 20 times. Recognition as an asset class is significant. The introduction of a spot ETF is another milestone. The move towards standardized fair value accounting through initiatives like FASB is also impactful. On top of that, the upcoming halving event represents another key factor. These 4 milestones are critical and are happening in rapid succession. Wall Street and the broader community are processing all this at once, which explains the optimistic sentiment. If you're an average person saving for retirement or your children, you might put money in a savings account earning 5% interest. But with inflation at 7%, 8%, or even 9%, your real return is negative. A negative yield of 3% to 3.5% over a century reduces 1 million in savings to just 30,000. For those saving in bonds with a 3.5% to 4% interest rate, while inflation is at 7% or 8%, wealth erodes over 3 generations, losing 97% of its value. Bonds and savings accounts just don't provide growth. The next logical consideration is the S&P 500. Historically, the US money supply grows by 7% annually, and the S&P tends to mirror this. If you invest $1 million in the S&P index, after a century, it would still be worth $1 million. While this preserves wealth, it doesn't generate significant gains. This assumes the S&P 500 will remain relevant for the next century and that conditions remain stable. Essentially, you're just maintaining your financial position, not improving it. Then there's real estate. For most people, purchasing buildings or warehouses is out of reach. Wealthier families can invest in properties like city blocks and warehouses. But these options aren't typically available to the middle class. How can you buy $4,000 worth of a building? You can't. That's the fundamental limitation. When you purchase shares or securities linked to real estate, your property rights are weaker than if you owned the actual property. When you own a building outright, you have full control. You can mortgage it, sell it, renovate it, or add additional floors above its parking lot. You can actively develop and enhance its value. In contrast, if you own a share in a REIT that owns the building, such as a 1/100 interest, you don't have any of those privileges. You have no authority to modify the property. You simply receive a portion of the cash flow decided by the general partner. If they make poor choices, you have to deal with the consequences, and you can't influence the outcome. Your property rights are severely limited, making this an inferior position for long-term investment. This brings us to the broader issue of securities. Suppose you have money and decide to invest in companies like Apple, Amazon, Facebook, or Google, or a REIT holding real estate. Securities have inherent risks that dilute potential returns. The first risk is management fees. Fund managers typically take 1% annually for overseeing the investment. They don't work for free. In the best-case scenario, it's just 1%. ETFs often charge around 90 basis points, meaning nearly 1%. If you invest in Bitcoin-related funds, they'll also deduct similar fees. Over a lifetime, the impact of a 1% fee on a perpetual asset compounds significantly. For an infinite duration asset, multiplying this fee by 20 to 25 times shows that managing $1 million investment can cost you 20% of your wealth. This means that by charging 1%, they take 20% of your total wealth. But that's just one issue. Running a company introduces labor risks. If the company's workforce unionizes, labor expenses rise. As profits are consumed by these costs, the company's equity value can decline towards zero. Labor unions can effectively wipe out profits. Another risk comes from competitors. A competitor with a superior product can force a company out of the market. Consider examples like Yahoo and AOL being overtaken by Google. Once great companies like Xerox and Kodak also lost dominance. The market set is full of similar cases where competition eroded a company's value to nothing. Technology poses yet another risk. Industries can become obsolete. You might own natural gas or oil fields, but if nuclear power becomes dominant, demand for your oil vanishes. Or you could produce the best chemical cameras, but digital photography makes them irrelevant. This technological disruption can wipe out entire businesses. Technology always carries risks. Digital cameras replaced traditional film cameras, showing how quickly products can become obsolete. Execution also matters. A company may produce an iPhone 13 that people love, but the iPhone 15 might disappoint. History is filled with examples like Firestone tires failing or the new Coke launch that flopped. Investing in a company isn't a pure investment. You're buying into assets vulnerable to unforeseen events. Natural disasters, wars, or tariffs can damage investments. For instance, a sudden 20% tariff on Chinese imports can severely impact a factory's profitability. Worse, a real war can lead to confiscated or destroyed assets. These risks are constant and unavoidable. The S&P 500 returns about 7% annually, but with inflation at 7%, companies merely maintain their wealth. Imagine eliminating all those risks, owning something immune to obsolescence, lasting for millions of years with no management fees, no labor costs, and no exposure to trade wars or conflicts. Imagine an indestructible, immortal, incorruptible product. When you buy Bitcoin, you purchase 1/21 millionth of all the money in its network. Would you want to own that fixed fraction of global wealth in 10, 20, 100, 1,000, or even 10,000 years? Bitcoin doesn't become obsolete. Technology like iPhones will eventually be replaced, perhaps by Apple Vision or telepathic implants. Phones, goggles, and TVs can all become irrelevant, but a fixed share of the world's energy and value will likely remain desirable. Einstein noted that energy cannot be created or destroyed, only transformed. Bitcoin represents a pure idea, free from competition due to its unique creation. It was developed by the anonymous Satoshi, who distributed 1 million coins without a pre-mine or ICO. The network is fully decentralized and owned by its users. Competing with this is nearly impossible. Bitcoin is a digital monopoly, free from labor risk, war risk, product risk, and execution risk. There is always execution risk involved. For instance, if you set up Bitcoin mining operations in China and the government decides to shut down mining activities, the miners incur losses. However, if you are a Bitcoin holder, this doesn't affect you directly. Bitcoin operates as an ideal monetary system where all improvements and maintenance are handled by miners, hardware manufacturers, and Bitcoin service providers like financial platforms. If companies like BlockFi or Celsius collapse, holders with Bitcoin in cold storage remain unaffected. Even if a hardware company fails, your Bitcoin remains secure. Consider the business model of McDonald's. McDonald's succeeds because it minimizes its own risks, pushing those risks onto franchise owners. Individual franchises might lose money, but McDonald's Corporation continues to profit because others are investing their capital. Similarly, Bitcoin functions as a decentralized, resilient monetary system. The risk falls on banks, miners, and individuals who support the network. When these entities succeed, Bitcoin holders benefit. If they fail, only those taking the risk suffer, while Bitcoin itself remains unaffected. This decentralized approach makes Bitcoin highly resilient to external shocks. For middle-class families, Bitcoin represents a form of digital property with global reach. It lacks the dilutive aspects of securities, currencies, credit instruments, or traditional real estate. If you buy a second property to rent out on Airbnb, multiple risks arise. Tenants might damage it, refuse to pay rent, or the city could impose rent control regulations. Natural disasters like tornadoes can destroy the property. Additionally, taxes could be levied by city, county, state, or national governments. If you need to relocate, you can't take the property with you. Eventually, after a century, the building will likely require significant renovation or rebuilding to remain usable. Property and credit instruments are not ideal for long-term wealth preservation, nor are they scalable. You can't invest $437 in a rental property every 2 weeks. Bitcoin, however, offers a form of global property that is easy to accumulate incrementally. In theory, if the S&P 500 yields 7% annually, Bitcoin could appreciate by 14% under similar conditions. This could provide a 7% real yield over a century, whereas the S&P 500's real yield is closer to 0%. Even the best managed real estate investments typically offer a real yield of around 2%. But these are subject to numerous risks. Will your descendants be able to manage a family property portfolio regardless of where they live? Can you trust that none of the thousands of politicians worldwide will pass laws that negatively impact property values over the next century? Reflecting on the period from 1900 to 2000, consider how secure it would have been to store a bar of gold in a local bank. Bitcoin addresses these uncertainties by offering a decentralized, digital store of value, immune to many risks faced by traditional assets. What are the chances you'll still have it after 100 years? Imagine owning a building in a major city like Moscow, Kiev, Tokyo, London, Paris, or New York. Would you still possess that building a century later? Where would you prefer to own a building or a bar of gold? History shows that gold was confiscated almost everywhere. You might have been safe in Zurich, Switzerland, but in most other places, your wealth would have been lost. Banks have failed and currencies have collapsed. If you were fortunate, you might have invested in property that couldn't be replicated. For example, a piece of land on Florida's Gold Coast, bought for $100,000 a century ago, could now be worth $50 million. However, residential property taxes would likely cancel out most of those gains. The only way to profit consistently from real estate is by owning commercial property that generates rental income exceeding taxes, insurance, depreciation, and maintenance costs. This is difficult to achieve in many parts of the world. Bitcoin offers an alternative, a form of property rights that allows you to acquire and maintain perfect property. It has minimal maintenance costs, is immune to damage, and cannot be destroyed by rain or tornadoes. It is also scalable, enabling you to purchase small amounts regularly, such as with a weekly paycheck. This makes it liquid and easy to sell, unlike a fraction of a building, which is much harder to trade. Mortgaging a building is complicated. In Kansas City, a bank familiar with local real estate might approve a mortgage. However, if you own property in Istanbul, few banks worldwide will grant you a mortgage, and it will likely be in Turkish lira, which depreciates by 30% to 40% annually, creating significant financial challenges. Bitcoin is digital property with global reach. You can store it for 100 years or even 1,000 years, offering a long-term perspective on wealth preservation. Banks worldwide are recognizing this. French, German, Singaporean, UAE, Spanish, and American banks are all entering the Bitcoin custody business. In contrast, none of these banks are likely to offer a mortgage on a house in Arkansas. Only a local Arkansas bank would consider it. Bitcoin stands out as a pure economic asset, free from the liabilities associated with securities, real estate, and other commodities. Its simplicity and accessibility make it especially appealing to middle-class individuals. For anyone on a regular salary seeking to secure their financial future, Bitcoin provides a compelling solution unmatched by traditional assets.